Hello, everyone, and thank you for joining us for today's webinar on unrelated business taxable income. If you're attending the webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, you will receive an email within 3 business days with access to your certificate of completion. I'd like to go through a couple of housekeeping items before we get started. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter the questions. Just type your questions and hit submit. We'll either answer your questions during the webinar or we'll save them for the end if we have time. You can also modify your audio settings to ensure good audio quality throughout the presentation. If you're using a telephone, please click on the Use Telephone Audio mode, or if you're listening through your computer, then please click on the Use Mic and Speakers option. Now let's go over those California CE requirements. As a reminder, to qualify for CE, you must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. We have 4, which means you'll need to answer 3, and you must complete the evaluation survey at the end of the webinar. And now a quick intro to our presenter, Lynn Henley, who heads our nonprofit tax practice. Lynn has been providing consulting and compliance services for more than 20 years to a variety of tax-exempt organizations, including public charities, private foundations, social welfare organizations, labor unions, you name it. Lynn holds a master's degree in taxation from San Francisco State University and an undergraduate degree from UC Berkeley. She belongs to the American Institute of CPAs and the California Society of CPAs. And I'll just go over some quick learning objectives. So during today's webinar, you'll be learning how to calculate net unrelated business income from advertising. We'll identify qualified sponsorship payments, and we'll also determine the treatment of income from a controlled entity. And with that, I will turn it over to Lynn.
Thank you, Debbie, and thank you all for being here this morning. Quick presentation overview. We're going to discuss the treatment of advertising revenue. We're going to look at qualified sponsorship payments and how to keep yourself away from unrelated business income. We're going to look at income from controlled entities, and then finally at royalties. These are topics on which we have received a number of questions over this past year, and also topics that we have touched upon in prior webinars that have really not looked at in depth. So I thought these were good choices. Now also, even if you don't specifically have advertising revenue from the publication of a magazine or a periodical of some sort, you may have a similar presentation on your website, and also the concepts that we're talking about this morning, although they relate to advertising revenue, in general, these are concepts that you need for the understanding of unrelated business income in general. So don't feel like you've logged in vain. These will be applicable if you're doing anything to generate revenue that's not directly related to your exempt purpose. So we begin with advertising revenue. If you think of this analysis as a decision tree, up at the top, you would have a not UBI or maybe UBI choice. So your first question is the activity that is generating the revenue related to the organization's exempt purpose. If it is related, then it's not UBI and you're done, and you can all go back to work doing whatever it is that you were doing before. If the activity that is generating the revenue is unrelated, then you may or may not have unrelated business income. So now you're confused because how can I not have unrelated business income if the activity generating the revenue is unrelated? Well, this is a good time for a quick refresher on the basic UBI rule. Remember from our previous webinars that there are 3 characteristics required of an activity in order for the revenue from that activity to be characterized as unrelated business income. Those criteria are that the activity not to be substantially related to the organization's exempt purpose, that it qualifies as a trade or business, and that it's regularly carried on. And all three of those elements are required. If we're missing even one of those, then we don't have unrelated business income. And let's go on to the next slide. So what is substantially related? Generating advertising revenue is not, in and of itself, an exempt activity. So if you were to read the code section, the whole entire 501c section, you would not see generating advertising revenue as an exempt purpose that would qualify your organization for tax exemption. But remember that the standard for being substantially related under Section 513 is a much lower hurdle than the standard for qualifying for exemption under 501c. So all we need to do with our revenue is to prove that it's substantially related under the Section 513 requirements. And that requirement is, and this is from a court case, in order to be related under Section 513, the advertising must contribute importantly to and bear a causal relationship to the achievement of the organization's exempt purposes. And I've given you the Treasury regulation site there, so you can read that at your leisure if you can't sleep at night. And I've also referenced a TAM there on your slide. It's a technical advice memorandum, and that's just an example of what it would mean to have related advertising. In the TAM, there's a student-run newspaper, and they sell advertising. But because they are learning to run a newspaper, the sale of the advertising qualifies as an educational activity rather than an advertising activity subject to UBI. So that's an example of selling advertisement where it would be related to the exempt purpose. Right below that, where you see the words possible exception. I'm going to go over the example, and then we'll talk about why it's a possible exception and not a for sure exception. So in this example, we're going to talk about some tulip importers. So we have the Tulip Importers Association, TIA, and it happens to be a 501c6 organization, but this would be applicable to 501c3 or 4 as well. So the Tulip Association publishes a newsletter, Tulip Trends. And in the Tulip Trends newsletter, there's all kinds of information about new developments with tulips and how to get the biggest crop and the prettiest flower and similar things. There's also information about new developments within the tulip industry. The advertising, and I put that in quotes because advertising it's a sort of a term of art when the IRS gets involved here. So we're going to say payments for offering your goods for sale. That's what we're talking about here. So the payments that the organization receives from persons who want to offer their goods for sale in the magazine is only from vendors who are selling the new products, the new tulips, or new equipment to make tulip growing easier and better. So what they're doing is they're tying the goods that are for sale to the content of the newsletter. The reason they're doing that is because there is a court case out there, American College of Physicians, and I've put the site there. In American College of Physicians, the college published the Annals of Internal Medicine, and included in the annals were a number of advertisements for pharmaceuticals, medical supplies, and equipment. Initially, the college filed Form 990T showing the advertising as unrelated business income. And for some unknown purpose, because it's not explained in the case, they then decided, they changed their mind, and they decided that they would request a refund of the tax paid from the IRS. The IRS denied the refund request, and then the college filed suit in the U.S. Claims Court. The U.S. Claims Court found that for the government, in other words, it said, no, this advertising is not related, you owe the tax. Well, the American College of Physicians was not happy with that, so they went to the Court of Appeals. Now, at the Court of Appeals, they found for the college, and they said the advertising contributed importantly to the exempt purpose of the college and therefore was not unrelated business income. Well, then the IRS was not happy with that, and it went all the way to the Supreme Court. When it reached the court, the Supreme Court reversed the Court of Appeals decision by indicating that the way the college approached the advertising in annals did not meet the stringent standards established by Congress and the Treasury. Justice Marshall wrote the opinion, and he was, in his opinion, he was referring to the requirement that there be that causal relationship to the exempt organization purpose, and that the activity must contribute importantly to the organization's exempt purpose. In other words, the taxpayer lost because Justice Marshall, in his opinion, was explaining that the court didn't think that the advertising in the annals met the high standard of contributing importantly to and establishing a causal relationship. So you think, all right, well, they lost an American College of Physicians. I better not have advertising, or I better be ready to pay tax if I put any kind of advertising in my publication. But here's where it gets murky. After Justice Marshall, explained that the college advertising didn't meet those standards, he then went on to provide a roadmap of what would satisfy the standards. And this is a quote from what he wrote. He said, considering the facts, in light of all the applicable legal standards, we're bound to conclude that the advertising in the annals does not contribute importantly to the journal's educational purpose. Okay, great. Then he says, this is not to say that the college could not control its publication of advertisements in such a way as to reflect an intention to contribute importantly to its educational functions. So he's saying if you would have done this differently, approached this a little bit differently, maybe you could have put the advertising included it in the educational function of your newsletter. And then finally he says, by coordinating the content of the advertisements with the editorial content of the issue, remember our tulip manufacturers coordinated their advertisements for new bulbs and new methods with the editorial content. It says, by coordinating the advertisements and the editorial content of the issue, or by publishing only advertisements reflecting new developments, perhaps the college could satisfy the stringent standards erected by Congress and the Treasury. So now we have a roadmap. Now, the IRS is not happy about the roadmap. So, although we have a finding and an opinion from the Supreme Court, the IRS may challenge your treatment of advertising even if the editorial content and the advertisements are aligned. So this is a maybe, and I wanted to explain that it could go either way. It depends on if the IRS looks at it or not, because their view is a very strict view, of course, of the necessary relationship between the editorial content and the advertisements. Our second standard to determine if we have unrelated business income is whether the activity is a trade or business. Now, what is very handy is that there is a volunteer labor exclusion from unrelated business income. And as you can imagine, one of the requirements of a trade or business is that, if it's run by volunteers, that's not a trade or business, because a trade or business pays the people that are providing the services. So if your advertising is handled strictly by volunteers, then you don't have to worry about it being UBI. And the phrase that is in the Treasury reg that we'll look at in a minute is substantially all. And although substantially all is not defined in the context of volunteer labor, 85% seems to be the standard in other areas of the tax-exempt law. Go to the next slide, please. Which brings us to polling question number 1.
Thank you, Lynn. So first polling question of 4, and if you're joining us for CE, you'll need to answer at least 3 of the 4 questions. Question 1 is, which of the following are needed for income to be treated as unrelated business income? Is it A, not substantially related or unrelated? Is it B, must be a trade or business? C, regularly carried on? Or D, all of the above? We'll give you about 5 seconds to answer the question. And we'll close the polls in 3, 2, and 1. And it looks like 87% said all of the above, Lynn.
That's terrific. Okay, that means that at least the sound is getting out to our folks who have logged in, so that's a good sign. The system is working. And thank you, Debbie. Our next, the next prong in determining whether we have unrelated business income or not is the regularly carried on prong. So what does it mean to regularly carry on an activity? So I've given you a couple of Treasury regulations above there in the slide, so you'll have that for your reference. So pursuant to the Treasury reg that's cited at the top of the slide, 1513-1C1, business activities ordinarily meet the regularly carried on standard if they have a frequency and continuity and are pursued in a manner comparable to similar commercial activities of non-exempt organizations. Thus, the frequency necessary for determining whether an activity is regularly carried on varies with the activity involved. The best example of this is a Christmas tree lot. The lot is only open for a few weeks in November and December, so you might think to yourself, well, that's not regularly carried on. That's only a few weeks in November and December. However, because the normal frequency and continuity of a Christmas tree lot is a few weeks in November and December, that lot is regularly carried on. Now, for those of you who have Christmas tree lots, don't be alarmed because you probably escape treatment as UBI through the volunteer exception. For this criterion, this regularly carried on criterion, there have been conflicting court decisions. In Suffolk County Patrolmen's Benevolent Association, the tax court ruled that the regularly carried on test should be based solely on the duration of the event rather than over the period in which the advertising activities occur. What does that mean? It's like, well, advertising, the solicitation of advertising may go on all year if it's a big enough event. You have people on the phone saying, do you want to sponsor our activity? You know, put your ad in our program. That could go on all year, whereas maybe the event itself is just a weekend or a few days. So there's always been this controversy about, well, if regularly carried on means that I have to compare my activity with the activities of a commercial provider, do I just look at the time that my event occurs, which is over a few days or a weekend, or do I have to look at the whole year? What counts here? There was the NCAA case, which is a case that's often referred to for this purpose. And I've given you the site on your slide in case you want to slog through it. The tax court held that selling advertisements in a tournament program, right? So people go to the tournament and they can buy a program with the players' names and history. So that selling advertisements in a tournament program was a separate business from actually handing out the program and conducting the tournament. So in other words, they said that selling the advertisements was a business, and then separately, whoever was circulating the programs was a business, and then the tournament itself, the playing of the basketball, that's also a separate business. So they were looking at this as three different things. And the tax court said that the amount of the preliminary time spent to solicit the advertisements and prepare the program for publication, and not the length of the tournament, was relevant to the regularly carried on determination. So they wanted, the tax court wanted to look at the whole year. And they ruled that although the sponsorship of a college basketball tournament and attendance circulation is a seasonal event, the trade or business of selling the advertisements is not. So they're saying you were selling advertisements all year long, commercial entities sell it all year long. So that's going to be UBI. Well, of course, the NCAA appealed to the 10th Circuit. The 10th Circuit agreed, and here's where this gets a little weird. 10th Circuit agreed that selling advertisements is a separate business, but then they concluded that the actual selling only occurred during the tournament, right? And the tournament is a few weeks, whatever that is. And the 10th Circuit determined that that wasn't regularly carried on. So they agreed with the tax court somewhat, but disagreed with them on the duration. And the 10th court, in its opinion, held that the programs containing the advertisement were distributed over less than a 3-week time span at the event, and that only occurs once a year. And they considered that to be sufficiently infrequent to preclude a determination that the advertising income was regularly carried on. And they said that viewed in this context, we conclude that the NCAA program, which is published only once a year, should not be considered an unfair competitor for the publishers of advertising. So in NCAA, you can see that the court was also bringing into consideration what they felt was the underlying purpose of the unrelated business tax in the first place, which is unfair competition against for-profit businesses. Now, once again, the IRS disagrees with the 10th Circuit NCAA decision and has actually indicated that it will litigate the issue when it has a good chance. So as soon as a good case comes by, I think we can expect some additional litigation about what time span should be considered regularly carried on. So one thing I wanted to do for, we can go to the next slide, for those of you who actually have publications, is to just show you the math real quick when you want to calculate your taxable income in the publishing environment. We'll go through this rather quickly because not everyone has the situation, but for those of you who do, this might be a little surprising, something you don't know already. So if we're going to calculate the tax, and there's like 3 slides here, so wait till the end. And it's like a big finish. Okay. So calculating taxable income in a publishing environment. So you divide your advertising activities from your non-advertising activities. So we have advertising revenue less advertising costs, of course, to get our net advertising income. And then separately we say, okay, what's our circulation revenue? What is our readership cost? And what's the net income from the non-advertising activities? So let's go to the next slide. So let's look at some definitions real quick. Advertising revenue, of course, that's going to be your gross receipts from anybody who is paying you to advertise in your publication. And then we have something called direct advertising costs. Now, when you read about this, they will use the word direct advertising costs. Well, direct is misleading because it really should say, you know, the normal, allocable, ordinary, and necessary expenses. Because you can see from the examples that I've included there on your slide about what expenses may be taken against advertising revenue, it's clearly not just what we would normally call direct costs. It includes depreciation, okay? Now, the commissions, of course, we would normally consider that direct, and probably the payroll of the inside salesperson that's handling our advertising. But then they go on to say you can take an allocable portion of office overhead, you know, rent, utilities, and then allocable mechanical and distribution expenses. So if you are just actually distributing a newsletter or magazine, you're going to have distribution and printing expenses, and some of that will be attributable to the advertising. And the IRS actually does suggest that it's a matter of lines, right? How many lines in the advertising, and how many lines in the publication in general, and you just allocate based on that ratio. And the next slide, please. And then for circulation income, it's all the non-advertising revenue. So if you look at it, you have one pie. You've carved out the advertising revenue. Everything else falls into circulation income. So paid subscription, charges for reprinting and republishing, sale of back issues, and a portion of the membership dues under certain circumstances. So if you have this situation where when someone pays the membership dues, they automatically get the newsletter and they have a right to receive that newsletter, you may have to allocate a portion of your membership dues to circulation income. And then finally, you have readership costs. That's all your expenses related to the your activities that aren't advertising. So again, it's sort of this, it's what's left in the pie. So that's a pretty easy number to figure out. Okay, next slide, please. Okay, in example 1, our circulation income exceeds our readership costs. So we have a $2,500 net profit from our non-advertising activities. And then we separately look at advertising revenue less advertising expense. And because our revenue exceeds our expenses, we have net advertising income of $9,000. So that's our UBI, 9,000. So that's example 1, where we make money from both the circulation and from the advertising. Now, in example 2, our readership costs, so what it costs us to publish this newsletter or magazine, costs us more than we can earn from it in circulation income. So circulation income, $18,000, readership costs, $21,500, so we're losing about $3,500. Our advertising revenue, we're still making money on the advertising revenue. And here's where it gets interesting. You can see that although our net advertising income is still that $9,000, we can reduce what we pay tax on by the loss in our circulation activity. Okay, so we're not paying tax on $9,000, we're paying tax on the $9,000 less our loss from the circulation activity. So UBI, $5,500. And I have a little treasury reg noted there because I know that sometimes that seems a little funky. It's not usually what we get to do. You usually can't offset UBI by other expenses, but this is a special publishing carve-out. And then finally, in example 2, we're losing money. I'm sorry, the next slide, please. Example 3, we're losing money from our circulation and readership costs, and we also have a loss from our advertising activities. Now note here that although the net loss from our advertising activities is a loss of $2,000, and we still have our circulation readership loss, we cannot increase our UBI loss by the loss in the publication activities. So we're limited just to that $2,000 loss, and we carry that forward. So, and I think the easiest way to remember this is that the loss in our publishing activities can only reduce our UBI income down to 0. It can't go any farther. Okay, so that's the math on that. Which brings us to polling question number 2.
Thanks, Lynn. So our second polling question, again, 2 of the 3 that you'll need to answer if you want CE credit. Second question is, when considering if trade or business is regularly carried on, which items must be considered? Is it A, whether the organization engages in the activity daily? Is it B, the normal time span of the activity? Or C, the net income generated by the activity? And just as a reminder, for those of you who are wanting the slides from the presentation for today, because Lynn is giving such great examples, we'll be sending them around tomorrow via email, so you'll receive an email from me with the slides to reference. We're getting our answers in here, so we're going to close the polls in about 3, 2, and 1. And it looks like 85% said B, Lynn.
That's great, Debbie, and that's great because it is the normal time span of the activity. So super. We'll move right along here. Just one more note on publication. Sometimes an organization will have multiple publications, and when you do the calculations for the UBI, you can either do each publication separately or you can consolidate them. And there's some great strategies involved with that. So, and we can help if you have multiple publications. I'm not going through the details of that because I'm not sure that applies to anyone, but just so you know that that option is out there. And we'll go to the next slide. Great. Oh, and now we have advertising versus qualified sponsorship payments. And I love the little become a sponsor out there. So generally, advertising is unrelated business income. And what is advertising? You can see a couple of notes there, and then we'll have a more detailed explanation in just a couple slides. So we have qualitative or comparative language and inducement to buy. Come buy my product. That's advertising. A sister activity to advertising is something called a qualified sponsorship payment. Section 513I. It isn't. It's not going to be unrelated business income if the sponsorship payment meets the statutory definition. And remember that we have a 2% limit on substantial return benefit. Okay, so that's your little introduction. Now let's look at what all of that means. And before we proceed, when you're reading about whether you have a qualified sponsorship payment and how advertising should be handled and what to do, in a lot of the articles and guidance from the service and from others, when you're reading about this topic, the word advertising can sometimes mean specifically payments treated as advertising. In other words, payments about which the decision has already been made that it is taxable. Or it can mean payments that you've received to put some sort of acknowledgement or ad on your website or in a publication where the jury is still out with regard to the treatment of those payments. So just be aware that when you're reading about it, advertising can mean either of those two things, and so it becomes a little bit tricky. But maybe if you're armed with that going in, maybe that'll be helpful. And just a reminder that can we go back to the previous slide? That this revenue realized from the sale of advertising in a periodical is gross advertising income only if the revenue is produced in an unrelated business activity. Because remember, we looked a while ago at what related advertising could be. Okay, next slide, please. And one more. So before we get to polling question number 3, I want to talk to you about where qualified sponsorship payments came from and how it was developed. In the early 1990s, the IRS issued a very controversial technical advice memorandum about a couple of football bowl games. You know, just so for example, let's say you have the Cotton Bowl sponsored by, you know, Exxon. So the IRS, and there were the sponsor gets various perks for being the sponsor, in addition to the acknowledgement. And it was all very confusing. And the practitioners didn't know what to do, and the people at the bowl game didn't know what to do, and the IRS was kind of confused. So what they did is they created a new code section. It's 513I. And they created a whole new thing called a qualified sponsorship payment. Now, and we're going to call it QSP. QSP is a payment made by a person engaged in a trade or business, generally a corporate sponsor, with respect to which there is no arrangement or expectation that the sponsor will receive a substantial return benefit, other than the use or acknowledgement of the sponsor's name, logo, product lines, etc. So in other words, a payment made that looks a whole lot more like a contribution than it looks like payment for advertising. The QSP is a safe harbor. So if you qualify, if the payment qualifies as a QSP, it's not going to be subject to unrelated business income. So if you have something that you can fit into the QSP definition, that makes your life a whole lot easier. First step in this analysis is to ask if the only thing the sponsor is receiving is the use or acknowledgement of the sponsor's name, logo, product lines, etc. So if all you're doing is saying, you know, the Bob and Jerry Maguire Corporation, proud sponsor of PBS show, you know, on English history, that's just a pure acknowledgement of, you know, the Bob and Jerry Maguire Foundation, and that's not advertising. So let's go to the next slide. I think we'll be able to explain a little bit better. In fact, let's go to polling question 3, and then we'll go on to this.
Thanks, Lynn. So polling question 3, really quickly, so Lynn can get on with the good stuff, is true or false, all revenues received from corporate sponsorships must be taxed as unrelated business income? A, true, B, false, or C, not sure. And again, if you're on for CE, you have to respond to 3 of the 4 polling questions. So this could be your last required one if you've responded to the first 2. And we'll close the polls here in 3, 2, and 1. And it looks like 89% said false.
Oh, well, that's terrific. We're going in the right direction. Thank you, Debbie. That's great. That's true. It's, sometimes it's taxable, sometimes it's not. We can get those sponsorships in the qualified sponsorship payment area. We don't have to pay tax on that. So let's look at what the Treasury and Congress meant when they said that the sponsor couldn't receive a substantial return benefit. So what qualifies as a substantial return benefit? Well, advertising, as specifically defined in the Treasury reg, an exclusive provider arrangement, and we'll look at the details of that in a moment. A substantial return benefit also includes providing facilities, services, or other privilege to the payer or persons designated by the payer. And that is subject to a de minimis exception. So that number 3 is you have a corporate sponsor and you give them 100 free tickets to the event, right? It's like, oh, so that I'm providing a privilege to the payer of my corporate sponsor. So is that going to be a substantial return benefit, or will it fall in the de minimis exception? And we have to figure that out. And also, if you grant the sponsor or someone designated by the sponsor an exclusive or non-exclusive right to use an intangible asset, such as your trademark, patent, logo, etc., then that's a substantial return benefit. And the key there is that it's an exclusive right. So if we look at the number 3, which is where I'd like to focus, we're talking about the de minimis exception. So that de minimis exception allows the recipient of the payment, in other words, a tax-exempt organization, to provide the sponsor with benefits that have an aggregate fair market value of not more than 2% of the sponsor's payment. So let's say the sponsor gives you $100. As long as the benefit that you give back to the sponsor doesn't have a value of more than $2, then this falls under the de minimis exception. And again, we're trying to get this QSP to look much more like a contribution than it does a payment for advertising. Now, if the fair market value of the goods or services provided to the sponsor goes over the 2% limit, then the entire fair market value is a substantial return benefit. And just as a reminder, a substantial return benefit does not include that pure acknowledgement of the sponsor's name, logo, or product lines. And in that acknowledgement, you're certainly allowed to mention the sponsored locations, their telephone numbers, internet address, slogans, value-neutral descriptions of the sponsor's goods or services. And that will still fall under the definition of QSP. So on the next slide, we're going to look at the details of an exclusive provider arrangement, because a lot of times a sponsor will want you to offer them the exclusive provider arrangement. So, and these can be these are big dollars that we're talking about. These arrangements are typically structured as follows. Company C agrees to pay exempt organization U, and in this case a university. So this for-profit company agrees to pay the university some amount of money if the university agrees to permit only the sale of C's product in campus vending machines, cafeterias, snack bars, and at sporting events. So without naming a brand name, say for instance you go to a particular college and you see only one brand of soda everywhere. That would be probably due to an exclusive provider arrangement. Now, the university is not obligated to do anything with regard to the sales of that particular soda. They're just obligated to keep other soda sellers off the university. Now, the IRS asserts that this kind of arrangement, limiting the sale, distribution, availability, or use of the competition's products, generally results in a substantial return benefit. In other words, that's not going to fall into the QSP definition. But you're saying to yourself, okay, but what exactly, what are the details of these exclusive provider arrangements? So an exempt organization is not deemed to have entered into an exclusive provider arrangement where the nature of the goods or services to be provided necessitates the use of only one provider because of limited space or because the competitive bidding process requires only the lowest bid to be accepted. So for what they're saying there is that if there's some other reason why you only have one brand of soda on your campus, because maybe you don't have enough space or because there was some bidding arrangement and they won, right? So if it's something other than the fact that they gave you this big sponsor payment, then that's not going to be an exclusive provider arrangement that will kick you out of the QSP. So, and a reminder here, even if you have an exclusive provider arrangement that disqualifies the payment from treatment as a qualified sponsorship payment, it still might not be UBI. It's just like once you determine that it's not a QSP, then you just can't use that exception. But you can still look at all the other exceptions to UBI, so the payment still might not be advertising. I think the short way to put that is it's a long trip from, oh, I don't have a QSP, I must have taxable income. So that's not the leap you want to make. You just say, oh, I don't have a QSP, now let me look at the other unrelated business income rules. So that's a good way to think about that. All right, sponsor recognition may be advertising. Okay, there is a rather fine line between sponsorship and advertising, and we're going to go through, I think, 3 examples to sort of give you an idea about how to tell one from the other. So advertising is a message that contains qualitative or comparative language, price information or other indications of savings or value, or an endorsement or inducement to purchase, sell, or use the sponsor's products or services. So that's advertising. On the other hand, logos or slogans that are an established part of the sponsor's identity are not considered to contain qualitative or comparative descriptions. So on your website, you could have a company logo, and that's not going to be considered advertising as long as there aren't any of those other elements, the qualitative or comparative language, etc. So let's look at the examples. Well, I guess we're just going to have to listen to the examples. So example 1, we have raise shoes. And let's say that there's a commercial, a radio station, and it's playing, you know, it plays jazz. Okay, plays jazz, and Raise Shoes has given the jazz station a payment. And then the station makes the following broadcast during the program. It says, this program has been brought to you by Raise Shoes, located at 123 Main. For your footwear needs, give them a call today at 888-1234. This station is proud to have Raise Shoes as a sponsor. So in that verbiage that the radio used to talk about Raise Shoes, there was an inducement to buy. It said, give them a call today. So that throws you out of the qualified sponsorship area and puts you into advertising because you have an inducement to buy. In another example, the radio station says, this program has been brought to you by Raise Shoes, featuring the finest selection of shoes and socks. The station is proud to have Raise Shoes as a sponsor. In that, when the radio announcer said, featuring the finest selection of shoes and socks, it was endorsing Raise Shoes, his products. That is qualitative or comparative language, and again, that announcement would be advertising. In our final example, we have the radio announcer saying, this program has been brought to you by Raise Shoes, located at 123 Main. This station is proud to have Raise Shoes as a sponsor. None of that is advertising. That is a simple acknowledgement. There's no qualitative or comparative language, no inducement to buy. So that, hopefully, that was a little indication of where the line is between the advertising and the qualified sponsorship payment. Okay, go to the next slide. Income from controlled corporations. We have touched on this in previous webinars, but we haven't gone in depth. So, and we're seeing more and more taxable subsidiaries and tax-exempt subsidiaries. In the C3 and C4 context, we see one tax-exempt organization controlling another, and a lot of our schools and 501c3s are finding ways to generate revenue that, good news, bad news, they're really generating a lot of revenues, and in order to protect the exempt status, that revenue stream has been spun off into a separate corporation. So you know that generally interest annuities, income from royalties, and passive income from rental real estate, as long as none of these things are debt finance, generally excluded from treatment as that should be unrelated business income. I don't know what UGI is, but it's an interesting acronym. So it's generally excluded from treatment as UBI. In the context of controlled corporations, there is something called a specified payment. And a specified payment is a payment from one organization controlled by another organization that reduces the net unrelated business income of the controlled entity. So let's look at some examples because it gets a little confusing. So next slide, please. What is a specified payment? Interest, annuities, royalties, rents. These are items that if a taxable or tax-exempt organization within its unrelated business income activity pays interest to another organization, interest is deductible. So it either reduces the taxable income of the taxable organization or it reduces the UBI of the tax-exempt organization. Same with annuities, royalties, and rent paid to a third, paid to the parent. We'll use parent, it's a little bit easier. So the payments from the controlled organization that are deductible by that controlled corporation to the parent are specified payments. Notice that dividends are not included in the definition of specified payments. That's because dividends are not deductible. We don't have to worry about them. And we go to the next slide, please. What is control? When does one entity control another? A stock corporation is controlled if a tax-exempt organization owns, by vote or by value, more than 50% of the stock. Now, in the case of a 100% taxable subsidiary, the tax-exempt organization is absolutely in control. And if they own 51%, they're in control. Similarly, with a partnership, we again have the 50% threshold, and it'll be the profits interest or the capital interest, because that's how partnerships are owned. And in any other case, when you have more than 50% control of the beneficial interests, you're going to be considered control. And then you usually find that in the trust context. That last line on the slide where it says the control of a tax-exempt organization can be established through power of appointment. If you look at the bylaws of a tax-exempt organization, and there's a right to appoint more than 50% of the board members, then that one organization is actually in control of another because it has a right to appoint more than 50% of the governing body. A lot of times in a C3, C4, or C3, C6 environment, there'll be more than 50% overlap on the board. So in other words, more than 50% of the subsidiary's board is comprised of board members of the parent's board. And so again, you have control of one organization by the other through board membership. So it gets a little complicated. You have to look at various pieces of information and also be aware that control can exist of one tax-exempt organization by another. Next slide, please. So let's look at how this works. Public Charity A has the authority to appoint 75% of the directors of Public Charity B. So we know that A controls B. Charity A is going to rent an office building to Charity B for $15,000 a year. And related to the property that Charity A owns, it has $3,000 of expenses, $1,000 of maintenance, and $2,000 for depreciation. So although it's renting out this building to Charity B, A still has some expenses related to the building. Okay, so we go to the next slide. Now, Charity B is doing some unrelated activity. So it has unrelated business income of $100,000 after deducting the rent paid to Charity A. Okay, so it's making one of those deductions that we talked about that is included in the definition of specified payment. Charity A because it controls Charity B, must report $12,000 of net rental income on its Form 990T. So where does that come from? Remember that Charity B deducted $15,000 of rent on its 990T because it paid rent to Charity A. So there has been a deduction, a reduction in tax paid to the government. When that $15,000 was received by Charity A, they had gross unrelated business income of $15,000, and then they were allowed to take those $3,000 of deductions for the maintenance and the depreciation. And what was left was the $12,000, and that's taxable. The reason the Congress and Treasury have set this up this way is because they don't want organizations setting up other corporations in order to avoid paying tax on unrelated business income. That $15,000 that was earned by Charity B in its unrelated activity should have been taxable. And Congress and the Treasury aren't going to let $15,000 of taxable income escape taxation just because it was paid to a controlled entity. So when you're trying to do the analysis of how much of this is UBI, the simplest thing to do is to ask yourself, if I collapsed these two organizations into one, what would my net unrelated business income be? And that is how you will get to the correct answer of how much you should pay tax on. So I see that I'm sort of up against the hour here. There's another example with a controlled tax-exempt organization and a controlled taxable subsidiary. So take a look at those. Oh, and we have polling question number 4. I guess we ought to get that in, Debbie.
Yes, we do. Thanks, Lynn. So our fourth and final polling question is going to be considered a controlled organization, a tax-exempt entity must own what percentage of a taxable subsidiary? Is the answer A, less than 50%, B, 50%, C, more than 50%, or D, you're not sure? And we'll close this one pretty quickly, so please get your answers in. We'll close the polls here in 3, 2, and 1. And it looks like 75% said more than 50%, which is great.
That's terrific. That's terrific. So just as a quick note on the royalty section, a royalty is a payment to an organization for the right to use trademark, logo, name, etc. So if you receive payments for letting someone else use your name or your logo, that's going to be a royalty, and it's excluded from UBI by statute. Where you can get into trouble is if you start performing services in exchange for that payment along with the royalty. So if you're considering licensing your name to an outside party, just have the contract reviewed so that you're not performing too much service, because then it changes from a royalty to a trade or business. So there's some slides there, and if it comes up, just give us a call. Thank you all so much.
Thank you, Lynn. So just really quick to recap, during the webinar, we've covered how to calculate net UBI from advertising, how to identify qualified sponsor payments, and how to determine the treatment of income from a controlled entity. We skipped a little bit about royalties, but Lynn will be available for questions, and we'll be sending out the slides tomorrow, and you'll receive your CE certificate if needed in the next few days. Thank you for joining us, and we hope you'll be on some upcoming webinars. Thank you, and have a good day.